Hey everybody, Roland and Ryan Deiss with Business Lunch. This episode, we're going to talk about something that came up through a conversation that was taking place in one of the text threads that I'm a part of, and somebody was asking. Actually, it was our friend John Asaraf was asking about whether it was best to be transparent with your financial information with your employees, or it was better to not do that. And if you were going to be transparent, how much information should be available? And I thought that was really interesting. Somebody came back and said, it was interesting too, because it was very split. Several of the people were, oh, heck no, that's your business. No, not anybody else's business. And several of the people were like, probably fewer of the people were, I'd say maybe even 70-30. 70 don't show anything, 30 be completely transparent. And they recommended a book called The Great Game of Business, which is an interesting book to read or listen to. It doesn't take very long to get through it.
Yeah, but, Jack Stack is the author.
Yeah, Jack is has a very ultra transparent kind of approach. And so I just thought it'd be kind of interesting for us to chat today about that. So Ryan, let's start with transparent or opaque. Which is better?
I mean, it's a spectrum, right? I mean, it's sort of like transparency with people, right? I mean, like, you know, I'm transparent with my wife, but do I say everything I'm thinking at all times? Like at some point, it's incredibly unwise.
You also have a survival instinct, is what you're saying,
right? It's like I don't want to die, and so no. I mean, I think I think completely opaque, telling your people nothing, that's bad. I think both extremes, is the case with all extremes, can be bad. I want to say, like, the happy, and I also think it's important to acknowledge there are people who say that you shouldn't share anything, it's your business. The thing I'd point out there is there's this thing called public companies that are out there. They do pretty much share everything with the public, and they tend to do just fine. So I don't think that it's necessarily one of these things where it's, where it's bad. We actually tried it like years and years and years ago. I remember reading, The Great Game of Business and Jack Stack. I was like, all right, this is the answer to everything. This is absolutely what's going to create employee buy-in. It's what's going to motivate them. And so we're implementing fully open book management. And for us, it was a disaster. And now I'll tell you, I don't believe it was a disaster because the concept is bad. I think it was a disaster because it was implemented poorly by us, right? So it's on us. Now, but the reason that we haven't sought to go back and try it again is because I think it's incredibly difficult for small entrepreneurial companies to implement it well. Because I think for most small entrepreneurial companies, they don't know their numbers either.
Yeah, and in fairness, he had a division of International Harvester. They were making hundreds of these big tractors and engine rebuilds a year. Had a large number of employees and fairly sophisticated financial information. So just so that you guys know that when you're thinking about your small or medium-sized business versus what I would call a large, medium, or large business that he has, there are some challenges and differences that come. So go ahead.
Yeah. So in general, I think like what we decided is we share our revenue targets. So we share here are the revenue targets with the company as a whole. So this is our 3-year target. This is where we're going. And then what we do is we say, anytime that I ever share revenue, I say, now I want to remind all of you, if we go and make $10 million this quarter, that doesn't mean that that me and the partners are all buying Lamborghinis. I hope you all realize that the amount of money that, just like in your own home, like when you receive a paycheck, you have to pay bills with that. We do too, right? So our goal, our target is we're targeting this margin. Right. And it's out of this margin where we're able to, grow and, pay back debts and fund investments. So we're able to do all that. So in general, we're happy to share revenue and margin company wide. With individual teams, like so for the programs team, for example, that's when we can get into, well, what's the gross margin of this particular program? So what are you spending on these different things? Because they need to manage that. But I think by and large, I'm happy to say, look, if you've got a question about the financials of the business, ask. But just in the same way that, like, I don't share all the details of our household finances with my kids. I'm not going to do it with our team, not because they're children, but because they don't have all of the context, and it isn't necessarily the information that they need to succeed at their job. And that is the question that I always ask is, what information does this person need to do their best work? And if that's related to finance, then great, let's talk about that. And if it isn't, then I'm happy to have the conversation. But are we going to necessarily put it out there for all the world to see? No, because it's not helpful, right? In our experience, it isn't helpful. So that's kind of where we've landed. What do you think?
I've gone back and forth on it. I think that one comment that he made, I is something that he didn't say it this way, but I've always said, like, when you're an entrepreneur and you have people that work for you, your employees all assume that gross equals net. And so they think that if your business generated $3 million this year, that you made $3 million, and they really don't think about it. I mean, they really don't think about expenses at all generally. And so what was interesting to me was that they polled their employees, and many of them believed that it was 50% or more profit. And I think that that's something that a lot of people think. And I think that also, like, if you listen to a lot of people that are in the information or e-commerce space or SaaS or services, a lot of the things that we're into, you'll hear margins of 40, 50, 60%. Frequently, those are gross margins, by the way. They're not taking out all the operational expenses, and they're not even allowing for compensation for the owners. And so, but what was interesting was that many people said that. So I think that if you really want to have buy-in from your employees to be motivated, and not think that you're just squirreling away millions and millions and millions of dollars, that letting them know what the margin is, they can do the math. So if you're going to let them know what the margin is, and you're going to let them know what the gross is, then you're effectively letting them know the net. And so you might as well tell them, because it's going to be way less in almost every circumstance than they believe it is, which will then help them feel like, oh, I see, like, I'm not working to make this person rich. And not that there should be anything wrong with that, because as long as everybody's getting what they want out of the relationship, it should be okay. But, fairness comes into play. So I think the first thing is, I agree with you. I like the idea of people knowing what those three numbers are. I think that's really important. So then,
just the three are revenue, profit margin, and I guess bottom line profit after they do the math.
Yes. Yeah.
Okay.
And I mean, whether you want to do the math or not do the math, I think it doesn't matter. But I like the idea of that, because then you get into assignment of ownership for different categories of expenses related to, what those things are. And just as we in the scalable operating system, we've got the key financials are the balance sheet, income statement, cash flows. Those are really, really important. I think that, like, that's got to be core. Now, what you said, I want to know, when you guys implemented it before, because that was before I came in, what do you think was the failure point?
I think it was twofold. Number one, our numbers were wrong. We didn't have good financials. And so what we were reporting was inaccurate, and we had to keep going back and changing things, because it was just, we were just trying to figure out. I mean, we were pretty early. I mean, like you said, you and I have been working together for 10 plus years, and this was years before that. So, I mean, we were still just trying to figure out what's an income statement, right? And so what we were reporting would change, and it made it look like we didn't know what we were doing, which was accurate. But at times it made it look deceptive, because it was like, oh, we're making all this money. It's like, oh, never mind, now we're not. And because the talking about it was tied to incentive comp, the result was that, hey, everybody, we're making a lot of money and you're all going to make these big bonuses next month. Oh crap, never mind, we got it wrong. You're actually not, right? And so what was it? It was incompetence. Right? Yeah, it was incompetence on our part, utter and complete incompetence. What did it look like? deception. And when you're
Yeah.
kind of choosing between incompetence and deception, so I think the first thing, if you're going to do this, you need to have your ducks in a row. I mean, really, you should be running solid financials for a good year and know what's going on. So I don't think that this is an early stage business kind of thing, right? It's not an early stage business kind of thing. This is for latter stage, businesses. You've been doing this for a couple of years. You've actually paid taxes. You understand your bills and you're paying them. And so I think that's kind of the first piece of it. The other piece was that we didn't do a good job of aligning the profitability of the company with the profit sharing. I'm sorry, the goals of the company with kind of the incentive comp plan that we were doing. So the incentive comp was based almost entirely on sales growth, right? And that's what we were incentivizing people to do: grow, grow, grow. Like everybody's comp was based on how much did we grow. It wasn't based on profitability. And so there were some months where we actually paid out bonuses where we lost money as a company. And so while we were going through all the trouble of explaining, or badly explaining, this is how a business works, and yep, this is what we make, and this is how much we actually get to keep at the end of it, we were doing that badly. And then we had misaligned incentives where we were trying to explain what profitability is and how it works, and contribution margins and all that other stuff. And yet we were compensating people based on just growth. And so I think you want to make sure that, again, it goes to, why do they need this information? How is it going to help them do their best work? Don't make a big deal about profitability, but then compensate people on growth. Because, what's the point? Just talk about how much money you're making, top line.
Yeah, I think that, what is that metric that is important to you? And growth is certainly a legitimate metric. It's not wise to make growth the metric with no regard to profitability and cash flow. Those are two things that I think a lot of people confuse. That the amount of profit that the business might be making from a financial statement accounting perspective might be fairly different in terms of timing from what the amount of cash that's going to be in the business is. And it's very scary if you are only focusing on let's grow or some other metric like this number of customers added or customer satisfaction or any of those things, right? There's a lot of goals that you might have, but generally there's one primary thing you're after, at least thematically, for a quarter. And so if one of those is growth, that's cool. You just have to decide, is that going to be growth at all costs? Because if it's at all costs with no regard to profit and cash flow, you might find yourself unable to pay bonuses and therefore have a lot of very upset employees, because if you can't pay those bonuses, you lose trust, right?
You and I had a person, an executive at one of our companies that we owned that was growing very, very quickly. And I'll never forget, one of the traffic managers was compensated based on, it was a combination of ad spend, the more the better, the number of clicks, the more the better, and the number of basically leads generated, right? So it was all just growth. And that's where all the comp was. And there was but it has to be at an acceptable, return on ad spend, ROAS. It was none of that. It was just grow. And this person was getting massive, $25,000, $30,000 bonus checks some months,
right?
When we're hemorrhaging cash,
right? Acting
like we were a funded company. And I think this is a mistake that a lot of entrepreneurs do, is they look at these funded companies that, have hundreds of millions of dollars in dry powder, who frankly know their unit economics way better than most entrepreneurial companies do and know how eventually this will ROI. And they try to model them. And you can't do that. You're trying to fund growth out of operating capital, and so you don't get to do that. So, I mean, I get into when we've done it, right, how that works, but I can tell you what definitely did not work was poorly constructed financials that changed all the time, poorly explaining how financials work. So I think also, if you want to implement any type of, open book accounting, you as an entrepreneur should probably take some accounting classes. Not kidding. You should know the difference between just gross margin and net margin. That's pretty simple basic stuff. And make sure that when you're doing it, that you are aligning whatever that number is to people's incentives.
Okay, we're back and we're talking about this open book accounting concept of should we make our numbers available to everybody in the company or should we not? Generally, Ryan and I believe it's probably better to be open at least about the amount of the company is making in terms of sales, the margin that it's operating at, and either you give them you do the calculation and give them the net, or they can do that math themselves. But we're generally both pro that. The most of the arguments against that I've seen don't make a whole lot of sense because if you don't give those numbers, they're going to come out anyway in terms of sales. Your employees are going to figure out what sales are, and then they're going to either assume that 100% of sales is profit, or they're going to assume that your profit margin that you're keeping is dramatically higher than it is, because they're not thinking at all like even just reinvestment and what you've got to put back into the company to keep it going, and what are the actual costs of operations below gross margin, below what the cost of the goods that you're selling or the services that you're selling are. They're not generally thinking about that. They almost always estimate too high. So knowing that, I think generally you're going to be better off to let them know, because at least they won't think that you are taking advantage of them and making all of this money when you're not. So now, when you get into kind of some strategies for implementing this, do you have any thoughts on that, Ryan?
I mean, again, we've done it wrong way more often than we've done it right. And many of the times we've done it wrong, it comes down to what you said earlier, which is cash flow, right? And so I've heard companies implement some kind of, so if we're talking about open like book management, like what you report on, I think we kind of covered that. So do you want to shift to the incentive stuff? Is that what we're going, or
I wanted to kind of talk about like how to lay it out. So if you're going to be mindful of doing this and you're going to say, okay, I want to have an open book system. And so I'm cool with that. That's easy. You just release those numbers. Now, if I'm going to release those numbers, to what detail do I release it? I think those three numbers are the only ones that they really need to know until you get into department heads who then should be really focused on the numbers that are applicable to them. And so one thing that was interesting in the Jack Stack book was that he said they assigned expenses to everyone in the company to own an expense. And one of the examples that he gave was toilet paper. And it's like, they'd spend a lot of money on toilet paper. It turns out they found out that when people were working more on the line, they used the bathroom less, and therefore they used less toilet paper. Now they have a lot of employees. For us, that might be, I don't know, a roll a week, but so it's not going to be any giant difference. But I think if you have a big company, to help someone get more ownership in something and feel a part of it, maybe giving those people ownership about some expense that applies to the whole company can be good. In a smaller company like ours, I think that, like most of ours, I think I like the department head kind of having that. That's a call. Yeah. But what I did really like was that if you lay out first, what is our goal for this year? And you say, and you identify your leading or lagging indicators and all the things we have in the scalable business system. And if you haven't checked out the scalable operating system, then you definitely should. And Ryan, where's the easiest place for people to check that out?
Yeah, if you go to scalable.co, scroll down a little bit, there's a button right in the center that'll take you to information about the Scalable OS. But yeah,
okay,
we definitely, this is where we cover exactly how we do exactly what we're talking about here. So
right. What I really like about certainly the way they talk about it in that book was that they lay out, this is our goal for the year, and this is our margin for that we're targeting. And so now I know if my goal is 10 million and my margin is 13%, then I'm going to make $1.3 million, or my margin is 25%, I'm going to make 2.5. And now from that profit, I need to have some ability to reinvest in the company and, the cost of operations. They set theirs at 5%. So on 10 million, that's $500,000, which is not very high, right? So that's like at a minimum before anybody gets any incentive compensation, they're saying the business ROI has to be 5%. And so anything above that, then they get into profitability. And I really thought, I liked the way that they laid it out there. And we haven't gotten to talk about this a lot, so it's kind of fun talking about it here. But basically, they divide into quarters what the target is, and then 5% of whatever bonus that's agreed upon. Well, first they say, here's the maximum bonus that anybody can get. The maximum bonus in his company was 13% for employees and 18% for managers. And so you could get 13% or 18% of your salary. So if you make $100,000 a year, you can make an extra 13,000 if you're an employee. You can make an extra 18,000 if you're a manager. So everybody really got that was possible, and that those were numbers that made sense because that would allow the company to pay them, but also have profit left over. So now then they're reverse engineering. They're going back and saying, okay, if our target is $10 million in profit this year, and we know that combined, we're going to pay roughly 15% when we average the 18% for managers and the 13%. If everybody was going to get the max, and that they would get the max if we did 10 million in profit, then we know that we have $1.5 million in bonuses that we have to give. We also know that we have 500,000 to hit our 5% minimum cost of operating that we want our minimum return on operations, right? So that's 2 million of the 10 million. And then I've got my margins and everything else. And so I like that because they really go into building the incentive based on, can we afford to pay this? Like, can we afford to pay that? And then they said that half of each quarterly bonus, half of each quarterly bonus, whatever it would be that the employees could receive, employees and managers could receive, would be paid immediately at the end of the quarter, each quarter. But if you missed, then the excess would be rolled over each quarter up till the end of the year. So that if you hit 10% of what you want, if you hit 5% during the first quarter and the goal was 10, then you missed by 5, but you could roll that over to the next quarter. And I just thought that was kind of an interesting concept. What do you think about doing something like that?
Yeah, I mean, so Founders Board members will know we did a couple of months ago, we did an intensive on this designing an incentive comp plan. So I can actually, share, it's basically what you talked about, because it was, I'll give credit where credit's due. A lot of this was informed by Jack Stack. But I mean, it's basically, establish the trigger. What's the minimum threshold that must be achieved before any payout is generated, right? Because out of profits, like you said, some of that profit needs to be paid out to other things. I mean, there's going to need to be taxes,
including taxes.
Taxes have to be paid. And so that's a big part of it. You may have debt service that needs to be paid that you're not currently factoring in as an expense. There may be obligatory distributions that are made to certain shareholders who have a preferred kind of thing that needs to be paid out. So here's the minimum threshold. You said theirs was 5%. I mean, you could say this is what we're kind of targeting. And that's the other thing I will say, the way we do it is we say, this is our 3-year goal. We set a 3-year target, and then that's broken into 90-day, for this quarter, our profit, our revenue target is this, our profit margin that we're targeting is this. And it could be 20%, 25%, 18%. We tell everybody what we're targeting. And then we tell them where we came in. Hey, we came in at 17% instead of 18. Came in at 22% instead of 20, right? So everybody knows, and this gets announced and talked about at the all hands meeting that kicks off a new quarter. So every quarter we're saying, this is the 3-year target we're shooting towards, and here's the quarter that we're in. We're a third of the way through to our 3-year target. This is our goal this quarter. This is what we're targeting in terms of profitability. And then remember, everything over and above this amount goes into the pool, right? So there's the trigger, then there's the percentage that goes into the incentive pool, and then it's who's included in that pool. And I'm a big fan of, if you can afford it, right? Again, the money needs to be there, the cash needs to be there, consistent profitability needs to be there, of everyone having some participation in the pool, right? Everybody having some participation in the pool. If you're going to talk about profitability, then I think you should align. I think you should align the incentive towards that. I think in terms of who gets what, determining kind of the payoff method. I think certain people are going to get a larger percentage of the pool than others, but I think everyone should get something. And then in terms of the payout timing, yeah, what you said, I love the idea of doing a quarterly payout, but it's a percentage, whether it's 50% or 80% of that quarter. The rest of it is held back to the end of the year. And so for us, the executive team participates in quarterly profit sharing. Everybody else at the company, they're generally getting an end of the year bonus. And so there's stacks. That way it feels a lot larger when it hits. It hits at a time of the year when people frankly are shelling out money, and it's traditional to pay out holiday bonuses anyway. It's also just good for retention throughout the year, right? To do that. So that strategy is exactly it. Make it known. This is our revenue target. This is our margin target. If we hit this is the percentage that's going to go into the pool. People understand their participation in that pool because it's explained as an aspect of their compensation plan. And you're sharing, hey, good news, everybody. This quarter, we were able to sweep this much into the pool. And I think that's the important thing to say, because it's not just about profitability. It's in light of us hitting this profitability number, we were able to sweep this much into the pool after all the other stuff's paid. And that's so incredibly important, because sometimes just because you profited it, that doesn't mean you get to keep it.
Yeah. And that to that end, lay over that your cash flow. You've got to have statement of cash flows. You've got to have an income statement. They are not going to be the same very often. They are very often not going to be the same. So just be sure that the cash is there to cover everything that you need to do, because the last thing
we literally sweep it into a different account. And I think that's important. It should be swept into a different account, and that's where it sits. It's money to be paid out, right? Instead of the balance sheet, but that is not operating expenses anymore, or operating cash anymore.
Exactly. Cool. Well, I think that's something for you guys to think about. So we'd love for you to let us know. I don't remember the site, the / on businesslunchpodcast.com, where people can, is it just / ask?
Yeah. Ask, ASK.
Yeah. So businesslunch.com / ASK. If you would like to ask questions, but don't just ask questions there. Let us know what you're doing, because we'd kind of love to see what other people are doing in terms of incentive plans. And, do you make the numbers available to your people or not? And if you do make them available, then what do you let them know? So that, I think it can be really helpful to you. So guys, thanks for tuning in this time. And if you found this helpful, please share it with a friend or 20 friends or even 100 friends. And we'll see you next time.